All right, so get this. We're diving into a company that's been around for almost a century,
Wow.
almost 100 years.
Lovely.
Central Securities Corporation, founded in 1929.
Hmm.
They've seen it all, market crashes, booms, everything in between.
Yeah.
You wanted the full story on them, right? Their history, how they performed that unique investment strategy, and what the future might hold for them.
Mm-hmm.
Well, you've come to the right place.
It's incredible, isn't it, to think about all the historical events Central Securities has weathered?
Yeah.
It really speaks to their resilience and long-term vision.
Okay, so let's rewind the clock.
Yeah.
I'm talking way back.
Okay.
It all started in 1929 with Central Securities. What's the big picture here?
Well, you have to understand that Central Securities isn't your typical fund.
Right.
They've always been focused on value investing, seeking out those hidden gems, those undervalued companies that have the potential to outperform over time.
Uh-huh.
And that approach has been a constant throughout their history.
We're talking about a 95-year-old fund here.
Yeah.
Give us the highlights of their journey.
Well, their approach has seen them through the Great Depression, multiple recessions, the tech bubble, even the 2008 financial crisis.
Wow.
What's fascinating is that in 2010, their annual report actually compared the Fed's actions in 2008 to the mistakes made during the Great Depression.
Oh, really?
They saw the importance of a stable financial system for long-term investors.
That's really interesting. So they were paying attention to the big picture, the macroeconomic trends, and how those could impact their investments.
Absolutely. They've always emphasized the importance of understanding the broader economic landscape.
Mhm.
It's not just about picking individual stocks, it's about seeing how those stocks fit into the larger puzzle.
Now, everyone wants to know about the bottom line, right?
Hmm.
How has Central Securities performed over those, 95 years? You're a big fan of CAGR, that compound annual growth rate thing?
Yeah.
What's the story there?
Yeah, CAGR is a great way to understand how an investment has performed over time.
Yeah.
And it's especially important for value investors like you. It shows you how those yearly gains can really snowball into something impressive.
Yeah.
When we look at Central Securities from 1989 to 2014,
Okay.
they had a market value CAGR of 8.9%.
Hmm.
Not too shabby.
That's pretty solid.
Yeah,
But how does that stack up against the S&P 500, the benchmark everyone always talks about?
right. The S&P 500 had a UGR of 9.8% over that same 25-year period.
Okay.
So at first glance, it might seem like the S&P 500 comes out on top,
Yeah.
but it's not that simple.
Hey.
Remember, Central Securities is a closed-end fund.
Right.
That structure plays a huge role in their approach.
Hold on. Closed-end fund. What does that even mean for someone who's not a Wall Street whiz?
Okay. Imagine a regular mutual fund. People buy shares, money flows in and out. It's kind of a free-for-all.
Yeah.
But with a closed-end fund like Central Securities, there's only a set number of shares available on the market. Once
Yeah.
they're gone, they're gone. Got new money flooding in or rushing out.
So they're not constantly reacting to the whims of the market.
Exactly. That's huge for value investors.
Right.
Central Securities can truly focus on the long game,
Uh-huh.
riding out those market fluctuations and investing in companies they believe in, even if it takes time for those companies to shine.
Yeah.
They're not pressured to chase short-term gains like some mutual fund managers might be.
Okay. I'm starting to see why you think this closed-end structure is so important for their strategy.
Yeah.
It really allows them to stay true to that value investing philosophy.
Right.
But there's one thing that keeps popping up in these reports that I have to ask about Plymouth Rock. Can you fill us in on that?
Plymouth Rock is super interesting.
Okay.
It's a privately held insurance company,
Right.
and Central Securities has had a major stake in it for decades. It's like their secret weapon.
Uh-huh.
Think of it like Warren Buffett's Berkshire Hathaway
Yeah.
and their use of insurance float. It's a powerful tool.
Break that down for me. What is insurance float, and why does it matter so much to Central Securities?
It's actually pretty straightforward. Float is essentially the money that insurance companies hold from premiums before they have to pay out claims.
Right.
They're sitting on this pile of cash that they can invest for the long term.
Okay.
Since Plymouth Rock is private, we don't have all the juicy details, but it's clear from Central Securities' annual reports that Plymouth Rock has played a major role in their success. It's like a steady stream of cash flow that they can use to fuel their investments.
Plymouth Rock is definitely intriguing.
Yeah.
It sounds like a key piece of their strategy.
Yeah.
But let's talk about something that might raise an eyebrow for some investors.
Okay.
The fact that Central Securities shares often trade below their net asset value,
Uh-huh.
that seems counterintuitive, right?
That's a common question.
Yeah.
You'd think that with their track record, their shares would be trading at a premium.
Right.
But closed-end funds can be a bit of a mystery to the market.
Yeah.
Sometimes there's a disconnect between the perceived value and the actual value of their holdings.
So are they just ignoring this? It
Oh.
seems like something they should be addressing.
They're not ignoring it at all.
Okay.
Central Securities has been actively working to close that gap.
Right.
They've been using share buybacks, buying back their own stock to reduce the number of shares out there.
Right.
It's a classic way to boost the share price and signal to the market that they believe their shares are undervalued.
So they're putting their money where their mouth is.
Yeah.
But you can't talk about Central Securities without mentioning the man who's been at the helm for so long.
Right.
Wilmot Kidd.
Yeah.
He's been leading this ship for over 40 years.
Wilmot Kidd is a legend in the value investing world.
Yeah.
He joined the firm in 1972 and became president in 1973.
Wow.
His influence on Central Securities is undeniable.
Mhm.
His long tenure speaks volumes about his commitment to their investment philosophy.
But he can't be CEO forever, right? What happens when he decides to step down?
That's a question many investors have had, but the 2021 annual report shed some light on that. John Hill, who'd been working closely with Kidd since 2016, officially took over primary responsibility for the investment portfolio at the start of 2022. He then became CEO in 2022.
So it was a smooth handover.
It seems that way. Hill was deeply involved in the fund's operations for years,
Right.
ensuring a continuity of philosophy and approach.
Right.
It wasn't like they brought in someone from the outside who might shake things up drastically.
That's reassuring to hear. But with all these changes happening in the market, the rise of ETFs, the shrinking number of publicly traded companies,
Yeah.
can Central Securities, with their focus on value investing and concentrated portfolio, still come out on top?
That's a question for the ages, isn't it? And it's something we can explore as we dig deeper into their more recent annual reports.
All right, I'm ready to keep going.
Yeah.
Let's see how they've navigated the ups and downs of the past few years.
Let's do it. It's fascinating to see how Central Securities has adapted over time while staying true to their core values.
I know, right?
Yeah.
Like in 2011, they were talking about the global population hitting 7 billion and the challenges that come with a growing planet, things like water scarcity.
Right.
But that same year, they also made a new investment in Mindspeed, a semiconductor company, riding the wave of the next generation of wireless tech.
Interesting.
It's like they're balancing a long-term perspective with a keen eye for emerging trends.
And they've never been afraid to voice their opinions on policy issues. In their 2012 report, they actually quoted economists calling for a complete overhaul of the U.S. tax system.
Oh, wow.
They even acknowledged the growing trend of companies moving operations overseas for better tax treatment.
It's almost like they were predicting that whole tax inversion debate that would heat up a few years later.
Yeah.
They're clearly paying attention to the forces shaping the business world.
Yeah.
But let's get back to their portfolio. We talked about Plymouth Rock, but what other companies did they have their eye on?
Well, back in 2011, their top holdings included some familiar names. Coherent, a laser technology company, and Agilent Technologies, a big player in the scientific instruments market. They definitely had their sights set on innovation and growth sectors, even back then.
And by 2014, they were highlighting Analog Devices, a major player in the semiconductor world, and the Bank of New York Mellon Corporation, a leader in financial services. So a mix of tech and stability, it seems.
Exactly. They're not just chasing the flavor of the month. They're looking for companies with a solid foundation, a history of profits, and a clear vision for the future.
Speaking of vision, we talked earlier about how their shares sometimes trade below their net asset value.
Yeah.
Did they ever offer an explanation for that? You know, why they think the market might be undervaluing them?
They addressed it head on in their 2015 report.
Right.
They essentially said, look, our success hinges on the performance of the companies we invest in, not on short-term market swings. They believe their long-term perspective will ultimately deliver value for their shareholders, even if the market doesn't always recognize it immediately.
That's a pretty strong statement of their philosophy.
Yeah.
But was 2015 a good year for them?
Well, their NAV that year was $23.53 per share, down from $26.18 the previous year.
Oh.
But they also pointed out that the S&P 500 was down as well. Context is key, right?
And in 2016, their NAV bounced back up to $27.12.
All right. Yeah.
They must have been pleased with that rebound.
They were, and they even doubled down on their approach in that year's report, saying they invest without reference to a benchmark index.
Wow.
They're truly marching to the beat of their own drum.
I love that. But they weren't oblivious to the broader shifts happening in the market, right?
Oh, absolutely not.
Okay.
They specifically mentioned the rise of ETFs and how the number of publicly traded companies was shrinking. They even admitted these trends were changing the landscape for equity investors.
So did they seem worried? Did they think their strategy was becoming obsolete?
Not at all. They emphasized that Central Securities' success depends on the results of the companies in which we invest, not short-term trading or market timing. They weren't going to abandon their principles just because the market was changing.
That's got to be reassuring for long-term investors.
Yeah.
But what were some of those companies they were betting on in 2016?
Well, their biggest holding by far was still Plymouth Rock, which made up a whopping 18.5% of their net assets.
Wow.
They also had significant stakes in companies like American Express, Bank of New York, Mellon Berkshire Hathaway, and Johnson & Johnson, a mix of blue chip stability and potential growth.
Okay, so they're clearly not afraid to make big bets on their convictions.
Yeah.
But were they completely ignoring the rise of tech? You know, the Googles and Facebooks of the world?
Not at all. In their 2016 report, they actually quoted an article from The New Yorker that talked about the incredible growth of Google
Hmm.
and how it had become the world's second largest publicly traded company, bigger than General Motors.
Wow, they were definitely paying attention to the tech scene.
Yeah.
And did they ever actually invest in Google or Alphabet, as it's known now?
Fast forward to 2017, their top 10 holdings that year included, you guessed it, Alphabet. It was their third largest holding, representing 7.5% of their net assets.
So they were adapting and embracing new opportunities. It wasn't just about sticking to the old guard.
Exactly. And their 2017 report also gave us a glimpse into their thinking about another tech giant, Facebook.
Okay.
They quoted a Facebook investor who was expressing concern about the platform's impact on society and even on children's brains.
It sounds like they were thinking about the bigger picture, the ethical implications of their investments, not just the potential for financial returns.
Which is Storo. They even quoted an article that argued against protectionist trade policies, a pretty hot topic even today. They clearly take a global perspective, considering the broader economic and political landscape.
All right, let's jump ahead a few years. We're in 2021 now, and the world is still grappling with the pandemic. How did Central Securities navigate those uncharted waters?
Their 2021 report is a fascinating snapshot of that time. They talked about the rise of cashless societies, the rapid adoption of electric vehicles in Norway, and even the great resignation that was sweeping the U.S. job market.
They were really tuned in to the social and economic shifts happening all around them. It wasn't just about the numbers. It was about understanding the human side of the equation, too.
Absolutely. And they saw opportunity amidst the uncertainty.
Yeah.
One of their big wins that year was Coherent, which received multiple acquisition offers and ended up being acquired by John in 2022.
So they were able to capitalize on the M&A boom that was happening in the tech sector, even during a global pandemic.
Exactly. But they also highlighted their long-standing investment in Plymouth Rock, which continued to be a steady and reliable performer.
Okay, Plymouth Rock is clearly a cornerstone of their portfolio.
Yeah.
But we've talked about Wilmot Kidd and his eventual succession by John Hill. What's the story with John Hill? What's his background?
Well, the 2021 report provides some background on him.
Okay.
He joined Central Securities in 2016 as vice president, became president in 2018, and finally took over as CEO in 2022. Before joining Central Securities, he was an analyst at Davis Advisors.
So he comes from a value investing background. That's got to be reassuring for those who have been with Central Securities for a while.
For sure. It seems like the transition has been pretty smooth.
Yeah.
Hill has been working side by side with Kidd for years, so there's a clear continuity of philosophy and approach. It's not a radical departure.
That makes sense. But the world is constantly throwing curveballs. We've got geopolitical tensions, inflation, rising interest rates. Can Central Securities' value investing strategy still deliver in this new environment?
That's the million-dollar question, isn't it? And it's something we can explore as we dive into their more recent annual reports. We'll see how they've weathered the storms of the past few years.
All right, lead the way. I'm eager to see how this story unfolds.
Let's do it.
So we're heading into the final stretch here, 2022 and 2023. Definitely some turbulent times in the market.
Yeah, their 2022 report doesn't sugarcoat things. Inflation was running hot, the Fed was raising rates, and the stock market took a tumble. Not exactly a recipe for smooth sailing.
And Central Securities being a long-term investor, they couldn't just escape that, right?
No, their NAV did take a dip, dropping to $40.48 per share, from $48.87 the previous year.
That's a pretty noticeable drop. What happened there?
Well, they point to the overall market decline, especially in the tech sector. And remember, they had a sizable chunk of their portfolio in companies like Alphabet and Microsoft.
Right, those were some of the big names that took a hit during that tech sell-off. It was rough out there.
It really was. But they also highlighted some areas where they did well, like their investments in energy companies. Those actually benefited from rising oil prices spurred on by the conflict in Ukraine.
So a bit of a mixed bag, but overall they seem to hold their own.
Yeah.
What about 2023? Did things start looking up?
Their NAV had a strong rebound in 2023, climbing back up to $48.23 per share.
Now that's a comeback. What was driving that performance?
A few factors. Inflation started to cool down, which gave a boost to growth stocks, even with concerns about slower economic growth and those rising interest rates. And wouldn't you know it, those magnificent 7 tech giants we talked about earlier played a big part in that recovery.
So their bets on Alphabet, Amazon, Meta, and Microsoft really started paying off again.
Precisely. Those 4 companies alone contributed 7 percentage points to their overall return for the year. Talk about a tech-driven rebound.
It's a reminder that even with a value investing approach, you can still benefit from those high-growth companies, especially when you have a long-term perspective.
Absolutely. But even amidst that strong performance, Central Securities didn't shy away from highlighting some potential risks. They talked about growing concerns over corporate debt levels and the increasing cost of servicing the U.S. national debt. They even quoted Bill Gross, the bond king himself, warning about the dangers of a financial system built on ever-rising asset prices.
So even when they're doing well, they're not afraid to point out potential storm clouds on the horizon. It's like they're always looking ahead, trying to anticipate what might be around the corner.
That's a hallmark of their approach. They also highlighted things like the ongoing labor shortage in the U.S., the challenges of fixing the immigration system, even the potential impact of artificial intelligence on industries like publishing. They were really grappling with some big, complex issues.
They definitely have a wide-ranging view of the world, that's for sure.
Yeah.
It's not just about dollars and cents. They're looking at the bigger picture, the social and technological forces shaping the future.
And that brings us to their overall outlook. Are they optimistic about the future?
Well, they acknowledge all the uncertainty out there, geopolitical tensions, climate change, technological disruption. It's a complicated world. But they also express confidence in their ability to navigate these challenges and continue delivering long-term value for their shareholders.
That's the key, isn't it? Being able to adapt and evolve while staying true to your core principles.
Absolutely. Now, before we wrap up, I have to circle back to Plymouth Rock one last time.
Right.
It's been this mysterious presence throughout our deep dive. Did they finally give us any more details in those recent reports?
They did. In their 2023 report, they emphasized Plymouth Rock's continued focus on underwriting profitability and maintaining adequate rates, especially with rising claims costs. They even included a link to Plymouth Rock's website where you can find their annual reports and dig deeper into their operations.
So for those who really want to go down the rabbit hole, there's a whole other world to explore there.
There certainly is.
Well, this deep dive has been quite a journey. We've covered nearly a century of market history, dug into the details of Central Securities' unique investment strategy, and even touched on some of the biggest challenges facing our world today. It's clear that Central Securities isn't your run-of-the-mill investment fund. They've got this long-term focus, a willingness to embrace change, and an unwavering commitment to value investing. Whether their approach can continue to outperform in the years to come, that's a question only time can answer. But their story is a testament to the power of patience discipline and a deep understanding of the companies you choose to invest in. Thanks for joining me on this deep dive into Central Securities Corporation. We'll see you next time.